Good afternoon, everyone. This is Joe Gordon with Gordon Asset Management, and we are here today on Tuesday, July 7th for our weekly market update. Most of the data we'll be looking at today has been provided courtesy of JP Morgan. They have an excellent quarterly slide deck that they do each quarter, and so we're using some of their slides today. It's great information, and it's mostly about reflection on things after 2 quarters of 2020. So, disclosures, not giving out any investment or tax advice or any kind of advice, but really reviewing the tea leaves and the data about what's going on out there in the market and all things related to the coronavirus COVID-19 issue. Okay. You can follow us on YouTube. You simply have to go to youtube.com and do a search of our firm's name, and you can look at any weekly presentation or sign up at wealthqb.com. All right, so let's go through the slides. I'm going to go pretty quickly, and again, you can get a copy of these slides for your personal use. First thing I want to look at is S&P index here at inflection points. And if you go back and you look at the second line here, PE ratio forward, go back to the tech bubble bursting March 24th, 2000. Here we are trading at 27 times forward earnings for the next year at a peak. Up 106% from the prior 1996. That was the bull market of the 90s. And then you see the peak to trough 49% down and to 2002 October peak. And so what you see is also then you go to the financial crisis in '07, trading at under 16 times earnings, much less. However, there was euphoria, and the market had been up 100% since the last trough in '02. And then you see a 57% peak to trough downdraft. And then now here we are on this mostly secular bull market since March of '09 up until a peak February 19th of this year. And then you see the massive downdraft of over 33% in about a month. And now we retraced all but 8% of it. And the point of this is just to show is even though the PE ratios were different, you see the nature of markets rising and then falling based on fundamentals, rising, falling on fundamentals. And then here we are this year, market at all-time high, February 19th. Okay, so if you look at valuation measures, we've had this slide in here before. You can see the PE ratio on a forward basis is trading at about 22 times earnings, 25 years historical, 16. And again, what this slide doesn't do, because this is the S&P index, it doesn't break out your 5 big megatechs. Very scarily, they've been kind of crowned with a whole new valuation methodology that I saw in another publication the other day. But if you look at them, they're trading at 30 times earnings, and they really drag this average up. The other 495 companies in the S&P are trading at about 16, 17 times. And that for there to be a permanent bull market rally, you have to have breadth, which means a lot of the others that haven't done well have to start doing well, pulling their weight. Okay, PE ratios and equity returns. The left chart says subsequent 1 year. On a graph, you can see from where we are at 22 times. Normally, the subsequent 1 year isn't all that good. If you look at a 5-year annualized return plotting, you see that future returns aren't all that good either from these levels. Now let's look at profits. On the left side chart, you see consensus analyst estimates, and then you see earnings recessions. And you can see the fairly consistent level, but obviously estimates were way high going into this year and through 21. And then you look at earnings growth estimates now. So what you see on the right is what they said at the beginning of the year, and for growth of, for example, 20% in energy earnings, but now revised to minus 104%. Well, in 3 months, the world's standing still. You can imagine that changed that. But even here over to the left where you see utilities, was 5%. That's what you'd kind of expect now, 1%. But more important, technology was 10% earnings growth, now 1%. And again, a lot of that 10% or the 1% revised is mostly the earnings of the megatechs, the 5 big crown companies, Facebook, Amazon, Apple, Google, and Microsoft. Basically, earnings revised down in every sector. So source of earnings per share growth, this one is a little bit interesting. You can see here, first quarter profit margins down 47%. and the average for the last 20 years is 4%. Revenue down, you'd expect that, and you see historical and share count about the same. But basically, you can see here year-over-year earnings per share growth in '08 down 40%, in '01 when the tech bubble burst down 31%. Each of these years had a nice snapback in '02. You see it in '09 and especially in '10. But then you see over here, we're down 49%, the most ever. We'll have to see what happens. It's way too early, but clearly the data doesn't look good right now. Okay, so now uses of profits. You can see here on the left, dividend cuts, suspensions, and increases. Essentially, on the left side, you see in every sector, there's some combination of companies are cutting and suspending in each particular sector, not so much in technology. Dividends actually rising. You see in utilities, not many cutting so far. The big story yesterday in North Carolina and Virginia, Dominion Energy selling for $10 billion all their natural gas assets essentially to Berkshire Hathaway, Warren Buffett. But basically, they wanted to cut their debt, which is what they're going to use the money for, because they said their dividend payout ratio crept up to 85% of earnings. They want to get it back into 65. So there are people that are increasing dividends, and you can see there real estate and utilities, the highest percentages in this chart. And then shareholder yield by sector over on the far right, you can see financials, buyback yield, but many of the major banks have been told they can't do. They've suspended buybacks, and some are even going to cut their dividends. Wells Fargo comes to mind of one that's already announced it. So we've looked at this before, but here's a great value versus growth relative valuations. When you have it above the line here, you see that growth is cheap, or growth is expensive, basically, and value is cheap. And when it's down here where we really are, you can see value is cheap. So it's been a growth-led market, and basically value's been on sale now for probably 2015 on, which is when the acronym FANG was actually coined by Jim Cramer. So with all that said, we can see value's on sale, but it's been on sale for 5 years. And then you look at share of the value index with a beta greater than 1, beta for market volatility on a 52-week rolling period, and you can see up here where we are, 55% as value of greater than 1, but it's way more than it was in '01 when value in '99 was basically even a bigger bargain than today by far. Okay, we look at this. The only thing here is a lot of noise, but just reiterate where people made their money. If you look at the quarter-to-date growth, up just under 2% for large cap growth, 1.5% for mid growth. Large value only up 0.3, so that's 6 times worse on a relative basis. And small value negative returns. But if you look at the year to date, you can see a wide disparity. Growth up 12%, value down 16%. That's huge. And again, value is a lot of your energy, materials, and financials. And then you also see it's even exaggerated. Growth, small cap growth. These are companies that could be biotech with no earnings or startups where they trade at multiple of sales. Not flatlining on the small cap growth, but then small value down 25%, which is huge. If you look at since the market low of 2009, you can see clearly on the secular trend, growth has doubled value on large caps. You can see it's not so much double, 50% more on mid, and it's almost a double, a little less on small caps. Also, PE ratios, when you look at current PE versus 20-year average, you can see essentially there is some disparity historically, but clearly on large cap growth, you can see that it is way out of norm. Large caps growth trading at 30 times versus a 20-year average of 19. On large cap, mid caps, almost 40 times versus a 20-year average of 20. Again, we like this chart simply to show you what sectors are moving, what's not. So for the quarter to date, you can see here energy gave back a lot of its winnings. The winnings mostly happened in April when oil actually hit a negative price per barrel. Year to date down 36. Materials did claw back a little bit with the economy reopening in the second quarter, up 2%, down 5%. But the bigger story is financials. Gave back some winnings in the second quarter. Also, it's still down 24% year to date. Switch over to technology, kind of flat in the quarter, but essentially up 16% year to date. And communication services, which there are some of the tech names were moved in there, is positive as well. So all in all, it hasn't been a really great story anywhere except recovery in healthcare, recovery in technology, and the stay-at-home economy, communication services, a lot of other things not so good. Okay. Factor performance, the only thing I'm going to look at here when you look at year-to-date numbers is momentum clearly, which is growth, is the whole story, up 7, some cyclical, a little bit positive, everything else negative, quality -3, low volatility -6, defensive companies and so forth. So when you look at any factor moving at small cap at the bottom, down 13.5, value down 18, it's clearly a momentum market, and that's the way it has been. Okay. Intraday declines versus calendar year returns. What's interesting about this is this gets you see historically back here right past 85. This is the 87 crash, so we did have a down 34, but it did end up the year positive. If you go over here and you say, well, what about financial crisis? Down 49%, and then you ended up the year down 38 or 37, the S&P. And then we have the -34, and here halfway we're down -3. So if history is any indicator, and we repeat the financial crisis, which I don't think we will, you're looking for retracing the initial dead cat bounce, and then you can see here it wasn't the case back in 87. If you look at 2000, it was basically -34 in 2001 and -23 for the year. So historically, there is a retracement and testing of the initial market lows. We'll see what happens. This is another chart just looking at major pullbacks since the financial crisis. And you can see it just graphed. There's always a pullback. There's a reason, something going on. It's either Fed or it's global slowdown. It's China. It's any kind of thing. You got Ebola in 2014. Then you come over here and you just see that there is dips, there is recovery. Hopefully that the trend will follow that, and we have that continue here, but we'll see. A lot of states closing up doesn't really sound great for that in the interim. Bear markets and subsequent bull returns. You can see here on the left, there's like 13 different events, if you will. I'm going to go back and look at the tech bubble number 11. Down 49, lasted 30 months, and so forth. And then when did the bull market begin? October of 2002, and then 60 months up 100. And we have where we are today, down 34. It lasted only 1 month, which is just hard to believe, not the case. And then you go back to 2009, we've been in a secular bull up 400%, or 135 months. What's interesting, if you look at this graph, you can say that's the fastest snapback ever in 1 month, peak to trough. And you see in the 87 crash, it was 3 months necessarily. But back in 87, one thing a lot of people probably don't remember, if you bailed out of the market when it was up 44% in August of that year, you had 9% long-term treasuries you could have parked safely in. We don't have that today. 30-year treasuries are yielding 1.5 or 6. Okay, stock market since 1990. When you look at other events, going up here to say last time we had stagflation with the Vietnam War era ending and the oil shocks with the embargoes of the 70s. Then you go up here to the Reagan era. Black Monday was the October crash, into the Cold War, tech boom, then correction, and so forth. But the trend is always to the northeast, even in spite of the setbacks. This particular chart, Great Depression and post-war recessions. You can see the current decline down 12% in real GDP. Who knows how long it's going to last? Financial crisis, since it was primarily limited to the financial sector, banks primarily, wasn't near as bad as it is today. So let's look at composition of GDP and growth. And most people know this. You always hear this. Well, it's all the consumer. It usually is consumption. The consumer is over 70%. You can see it's down to 68%. Housing at 4%. Investment ex housing 13%, and then government spending 18%. But with all the Fed liquidity injection, something's got to give. I mean, these things have definitely made a lot of the data look similarly. Okay, now switching gears because not a whole lot of coronavirus slides here, but a couple worth commenting. On the left side, you see confirmed cases and fatalities in the U.S. So we're doing a lot more testing. There's now just short of 3 million cases in the U.S., and you see fatalities just short of 130,000 as of the date of this slide, which is July the 5th. And then at the far right, if you look at confirmed cases in the blue line, you see it is going up a lot, 7-day moving average, but then fatalities, you can see it's still trending down. This is one of the slides that many of our doctor clients keep bringing to our attention, that the media is reporting on the wrong data, that even if a bunch of people in a bar in Miami test positive, they're 20 to 40 years old on average, they're going to probably pretty much fully recover, except for those that may have had some other pre-existing condition no one knew about. But it's really the most important data is how many are dying, and that trend is clearly to the negative. So it has been contained as far as the rate of growth in deaths, but you won't hear that on many media outlets. High frequency economic activity. Here's something that's very interesting. When you look at our economy, you see here, everything's chumming along right here, normal or above trend line, and then whoa, the economy shuts down, and so you see everything go down. Mortgages, 30 down 35%, but currently up 15. A lot of people buying homes. Money's cheap. You see seated diners down 100%. Now it's only down 73. TSA traffic was down 96%. Now down only 75. I think I heard yesterday that over July 4th, one of the days, there were 700,000 people going through TSA. Driving usage down 47, now back up 34. You can see the trend lines as they spike, with the restaurant thing is the one that's had the most of the jag here, because they're opening, now they're not serving inside, and then they're being told to shut down. And you see global flights, which is where a lot of the airlines make their money, still down 30%. Hotel occupancy was down 70, now down 40. So basically, the trend is not your friend if you're in any of those businesses. And now the consumer balance sheet, what's interesting here is on the left side, as you see, basically the total assets 127 trillion, total liability 16 trillion, a lot of financial assets, others. You can see basically homes make up a lot of the net worth of a lot of consumers. Cash deposits 9%, pensions 21%, etc. And then if you go over here and look to the right, household debt service ratio, basically the ratio is down to one of its lowest as far as people using a lower percentage of their incomes being debt payments as their personal disposable income. It peaked in 2007, where people are living much more hand to fist, and down here is basically 9.6% of disposable personal income used on debt service. Household net worth is still moving in the right direction, increasing significantly, over 115,000 on average. Income inequality, this is in the news a good bit. You know, I used to always feel income inequality is a function of education. But you can see here, basically the top 10% share of the pre-tax national income is over 50%. People say that's not fair. But if you look at the footnote, it's based on families. The top 10% of the decile includes families with annual income above 135,000. Most would say 135,000 is just plain average middle class, not much more. But anyway, spending as a share of income after tax. What's interesting, the top 10% only spend 69% of their money. They save the other. But the other folks, the other 90%, live hand to mouth. They don't have any room for savings. They're consuming 101% after tax, which means they're taking on credit card debt, likely. Okay, now switching gears a little bit. Long-term drivers of growth. if you look at over here on the right, growth in workers, growth in real GDP, in the decade that we're in, 1.4% growth in workers, uh, growth in real output per worker is actually increasing at a much lower percentage, which is cause for concern. There have been declining rates of growth in productivity per employee as we reach full employment and all-time low unemployment. So that is a concern. If you look at growth in working age population, basically you can see that there's not a whole lot of growth going on. 0.2%, 0.14 immigrants, 0.05 native born, and that's where we are 2020 to 29 projected. And right to the left, you can see the numbers. This is why you'll hear that we need immigrants, but then there's the debate between legal and illegal immigrants. Interestingly, with Hong Kong losing its democracy, apparently by new national law from Communist China, that Great Britain is offering to give citizenship at no cost for up to 3 million Hong Kong Chinese, since Great Britain was the former landlord. Okay, inflation. A lot of people are asking us, what about inflation? What about inflation? And you can see here, headline CPI and core CPI, it's just not there. The Fed has been trying to whip up inflation the last 4 or 5 years, and they can't do it. I would argue that if you look at technology overtaking everything, the Internet of things, that basically we are in a very deflationary period because technology improves your life and also lowers your cost. Okay. So what's going on in fixed income? A lot of people ask us, well, hey, the 60-40 balance portfolio, what's the 40 doing? I hear rates are zero bound. What are we going to do? So you can look and see current yields as of last week. 2-year treasuries 0.16. So think you're not going to get much money on your bank savings. But the 5 years only 0.29. Inflation tips down 0.73%. The 10-year is yielding somewhere in the 60 basis point range, 68 basis points last July 2nd, and the 30-year at 1.43. Safety, quality, you're not going to get much yield. If you look at other fixed income asset class, corporates down to 2. The U.S. aggregate index 1.25. Convertibles is where you can get some yield, but those are hybrid, part stock, part bond, but generally convertible bonds, and they're more equity-like too. You can get high yield credit, which blew up in March, late February, March, and the Fed had to come in and even bought some high yield debt. Municipals, you're not going to get much yield. Mortgage-backed securities, other asset-backed securities, and then floating rates. So literally, you have to take some credit risk or equity-like risk if you want to get any kind of yield, and that's just the way it is. So let's look at the yield curve. You can see here the Treasury yield curve in 2013 when things were more normalized and we were coming out of the last financial crisis. In 2013, you had 30-year at just under 4%, 20-year 3.72, 10-year at 3. Well, we're nowhere near that. In fact, you could say, well, we're basically 1/4 of where we were on the 10-year. We're about 1/3 where we were here and close to 1/3 here. Clearly, this is different times. And then if you look at fixed income yields in correlation to equities, you can see basically up here in the top right, it's where you have EM debt, high yield debt is more acting like and correlated to equities, convertibles, as far as fluctuations. Whereas when you go down here to the bottom left, you see very low correlation between flight to safety or treasuries, and then munis somewhat muted, but a little bit in the middle. A lot of clients are asking about where do I go, and that's why you hear quality companies, dividend payers have to have good balance sheets, etc. Other questions we're getting: private equity. What about private equity? Well, this is interesting because it just shows you 20-year returns in private equity versus the Morgan Stanley Capital International All Country World Index. So this is global stocks. You can see the 20-year return as private equity's doubled it. 15-year private equity 12.8, 7.4 for MSCI. 10 years 14% private equity, 9.4 for global equities. The point of this slide is because there are great opportunities in private equity. I would tell the first person who had a question about this that you have to give up liquidity if you want to get these returns. So if you don't like the notion of giving up liquidity to allow them to do their thing, then you probably should stay in listed tradable securities on one of the exchanges. One thing that is interesting in the bottom right, as you can see here, the U.S. private equity dry powder or cash is at an all-time high between 1.2 and 1.3 billion. And so there is a lot of money out there. They're waiting for opportunities. And you may see private equity joint venturing and buying companies that are hurting and so forth. And even last week, Amazon, there was a rumor, I'm not sure how true it was, that they might take a stake in Macy's or even buy the whole thing. That would be interesting. Okay. Yield alternatives, domestic and global. You can kind of see here the 50-year trend. Capital appreciation has been where you make your money. Average dividends 3.4% over this long period of time. If you look at it now, your yields are much less, and returns from capital appreciation in the 2010s to 2019 much better. Asset class yields we kind of just went over a little bit. We can see here if you want yield, you got U.S. REITs at 4, global REITs just under 5, infrastructure 5, emerging market debt 5.5, preferreds 5.5, then high yield, which means junk bonds for credit risks, just under 7, global transportation or transport, and then MLPs, master limited partnerships. So there is yield out there, but you just have to be mindful of the risk. Global commodities, the one thing I want to point out here on the left is gold has passed, actually this week, was over $1,800 an ounce. So there is a flight to safety with all of this money printing by our government and other governments around the world. So that's probably been the biggest thing this year. Silver is also starting to move a little bit, trading in the mid-18s per ounce and so forth. All the other industrial commodities are basically negative from where they were just because the economy shut down with crude oil getting down to $11 a barrel at the bottom at 40 currently. And then again, if you look at commodity prices and inflation, it just isn't over there. The last time we really had much even inflation fear was going into 08 when oil peaked at 145 a barrel, but purely on speculation and way before the discovery of fracking. And then lastly, gold prices, inflation adjusted, you can see where it was last week, just under $1,800 an ounce. Okay, fund flows, we're about to finish up here. One thing interesting here is you see retail investors year to date taking money out of equity funds, both in the US and global, also yanking money out of taxable bonds, to a lesser extent tax-frees, also out of multi-asset investments. And what are they doing with it? They're going into cash. Of the 1.1 trillion this year to date going into cash to an all-time record of 4.6 trillion. So one thing that gives us comfort is there is a lot of cash on the sidelines. Maybe it's cash just waiting for the market to drop and so forth. So finishing up, time, diversification, and volatility returns. Obviously, when you look on a one-year basis, stocks could have the highest returns historically, but also the lowest returns on a one-year basis. It's hugely volatile to go into stocks with a one-year horizon. It's anybody's guess. Bonds even, pretty good. Historical upside, downside not so much, but you can see much less volatility than stocks. And then a 50-50 portfolio is even more blended as a sensible approach. But if you look at 5-year rolling returns, you can see you tend to, if you're buy and hold, you have losses being minimalized after 5, pretty much going away after 10 and so forth. And then you see average annual returns over the last 20 years. You've been much better to be in stocks looking backwards. Diversification in the average investor. So if you look at this particular graph going back to 07, you see the dark blue is 40-60 stocks and bonds, the light blue 60-40 stocks and bonds, in other words 60 in stocks, 40 in bonds, and then the S&P. And you can see they're basically tracing each other nicely, bigger downdrafts in stocks when things crash like the financial crisis of 08, and then equities in the secular bull market take the way big time lead here from 2018 through today, but then we had the correction and then back up. So when you really look at 20-year annualized returns, you can see the best returning asset class is REITs. Is why we encourage clients to have an allocation of up to 10, maybe even 15% if you're that committed to the space. Gold, believe it or not, the last 20 years has done better than stocks. The S&P at 6.1, gold 8.6 annualized. And then you can see the other asset classes. The orange, which is the most embarrassing thing, is the average investors only made 2.5% because they tend to trade on emotion. They buy when things are sizzling hot and they sell when things start getting volatile. So the old thing, buy high, sell low, seems to be the behavioral thing of average investors. And honestly, that's why many of our clients like us is because we when they get aggressive and get greedy, we try to steady those behaviors and emotions. And then when they want to jump off a building because of a crash, we do the same. So in a way, we're like financial psychiatrists. Okay, so that's it for today. I think the takeaway I would like to close with is that while everything's not so rosy out there and we still have a lot of questions about this recovery and the shape it's going to take and the speed, there are some places you can go to diversify, both for income, yield, and alternatives like private equity. So give us a call if you'd like to discuss your situation. Look forward to helping you. Here's to a great third quarter. Thank you.